Okie dokie. So good morning, everybody, and welcome to our SSAS webinar. This is the second in a series of 3 webinars that we are dedicating to SSAS. In the last session, we looked at essentially what is a SSAS, what defines a SSAS, what are the requirements of a SSAS. And we also used or did a sort of compare contrast with SIP, because we know obviously most people are quite familiar with SIPs, what a SIP is, what it can do, etc. So we use that as almost like a benchmark. So comparing what are the similarities and the differences. There are a lot of similarities, but also some key differences between SIPs and SSAS. This session, we're going to be focusing more on sort of what you can do with a SSAS, really. So some sort of financial planning angles or case studies, if you will. No rocket science in any of it. You know, the case studies are fairly short and straightforward. You know, some of them even just a single PowerPoint slide long, so nothing overly taxing. But just hopefully just a useful summary of some of the reasons why a client might have a SSAS or what they could do with it. What I would say is, as we go through the session, a lot of you might be sat there thinking, well, there's a case study that Barry or Gemma have just gone through, but actually I could have done that with a SIP. You know, for example, commercial property purchase, you might be sat there thinking, well, my client could buy a commercial property with a SIP, so we don't need a SSAS. Well, that's a way of looking at it. I suppose our objective today is to ask you to look at it slightly differently, turn that on its head and say, well, I always knew that my client could use a SIP to buy a commercial property, but of course they could also do that with a SSAS. So should they be considering a SSAS instead? So it might be, you know, extending this commercial property example. It might be, are there other reasons for having a SSAS? Are they eligible? You know, is there a sponsoring employer? So is a SSAS on the cards or not? Possibility of loan back in the future, which might be a reason for using a SSAS. Or it might be a group of directors, and there might be a sort of cost effectiveness issue. You know, at what point might a SSAS be more cost effective as a single scheme rather than multiple SIPs? So yes, as we go through, you might be thinking, I don't need a SSAS for that, I could do it with a SIP. Like I say, I'm just asking us to flip that on its head and say, well, I know you could do it with a SIP. Have you considered using a SSAS? Okay. Compliance boilerplate. We make every effort to ensure the content of our presentations is accurate, is up to date, reflects current regulation and legislation. However, we're not authorised to give advice. The presentation is not, nor should it be construed as advice. Furthermore, we can't accept responsibility for any loss which might result from reliance upon the content of the presentation. There you go. A little bit of housekeeping then. At the end of the session, you'll be getting an email with a link to a feedback questionnaire. On completion of that, you should get access to a copy of the slides and a CPD certificate. Within the body of the slides, you should have your learning objectives, which hopefully will be useful for your CPD log entry. As far as our agenda today, we are going to basically just a very, very quick revisit of some of the key points from last time. So what is a SSAS? How do you establish it? What's the structure? And then sort of what is a SSAS? Why use one? And looking at some financial planning case studies. We won't be open for questions during the session, but we will find some time at the end to answer questions. So how do you ask us questions? If you take the mouse, hover your cursor at the bottom of the screen, you should see a number of options pop up, including a Q&A option. So if you open the Q&A box, you can type in your questions there, and then we'll answer the questions at the end. If we run out of time, and we answered a number of questions last time, but we didn't get a chance to answer them all. So just like last time, if we don't get a chance to answer all the questions, the unanswered ones, we will follow up in an email. So even if you're absolutely sure we're not going to get a chance to answer your question today, still type it in and we will address it for you. I say we, so I'm absolutely delighted again to say that I'm joined today by Gemma Fenton. Gemma is Head of Distribution at Talbot & Muir, and Gemma has vast experience in the SIP and SSAS market, and she, in her career, will have helped innumerable advisors and clients set up and establish SSAS. So I'm absolutely delighted to say I'm joined again by Gemma today, and we'll be sort of sharing the load during the course of this session. So welcome, Gemma. Nice to see you again. Hand over.
Hello, hi everyone. So, thanks very much for the introduction, Barry. First of all, though, I think what we'll do, as we did in the last session, is I'll start off with our first poll question. There's going to be 2 poll questions today. So, the first one is now. So, I really appreciate it if you could give us an answer. So the first question, have you advised on the establishment of SSAS? So do you do that regularly, perhaps 6 times a year, very rarely, or never? So if you could click your answers and then we'll have a quick look at the answers, what we come up with, what we've got. Let's have a look. Yes, I think this has come up as expected, really. So regularly, we've got 6%, which is 2 of you out there. Very rarely, 13 of you, which is 36%, and 21 of you haven't ever set a SSAS up. So for those of you, I think you're all on the right session. So for those of you who haven't done it, I hope you might leave today thinking, oh, I might be able to set up a SSAS now with some of my clients. I might feel confident about talking to them about SSAS. And then for anybody else, we hope you just have a good refresh on what SSAS is about. And also, I think some of the case studies that we're looking at will sort of maybe give you some thinking room in terms about how you can present SSAS as well to your clients, and hopefully give you a bit of confidence to go away with that piece. Right, so to start off today, I'm going to do a quick recap on some of the points that we were talking about in our last session, just run through the establishment of SSAS and the structure, just to remind you and set the scene, and then we'll move on and we'll look at why SSAS, and we'll actually go quite a bit into some details around the SSAS loan back piece, and then we will have a look at the case studies. So, right, from our last session, first things to say that SSAS is an occupational pension scheme. It's set up under trust and registered with HMRC. It has its own individual reference number, which is known as the PSTR number. You will need a sponsoring employer to be able to establish a SSAS. So that could be a limited company, and usually is a limited company. That limited company has to be a sponsoring employer. What does that mean? It means that there has to be at least 1 employee employed by the company, and there has to be a payroll established. Then the next part, which goes on from that, is who do you invite and who can you invite to be a member of the scheme. So you can invite up to 11 members of the scheme, and they all become member trustees when they join the scheme. And then the who bit, just to reflect on that, they do really have to be connected with the company or with a member in some way of the scheme. So, for example, what do we see? We normally see directors setting up their pension scheme. Potentially they'll then invite family members to come and join that scheme, or indeed they might also look at key employees and invite those type of people to come and join the scheme as well. Hopefully that was a good refresh to set the scene. Barry mentioned then in his introduction about the table, the chart that we were looking at in our last session. So we've just brought that up just to give you a bit of a reminder of the differences and then the similarities between SIP and SSAS. So without going through every single point on the chart, I think it's good to remember what the similarities are. So there's similarities around investments, so commercial property, borrowing, which shouldn't be mixed up with loan back. So loan back is the difference in terms of investments. You can only utilise loan back to the sponsoring employer using a SSAS. And of course, discretionary fund management, other types of standard assets will fit within both products. The other similarity then, get that out, is the retirement benefits and the type of retirement benefits that can be taken. They mirror each other, so you can take, your tax-free cash, your flexible flexi access drawdown, you can look at UF PLS, you can look at a phased option. So you've got those options right across the SIP or SAS. And then just to differentiate, the differences then really come, as I said, you've got the option to utilise loan back. And then in our last session, we went through in quite some detail about things like the membership of the SAS scheme, occupational versus personal, and we talked really about sort of the regulation, the trustees' duties, which you obviously have on the SAS side, and you don't have then on the SIP side. So look at our next one. So I really like this slide, and I just think this really illustrates on an infographic the differences between SIP and SAS. So if I just ask you to have a quick refresh on this one, on the SIP side, if we remember that SIP is a personal pension plan and it's an individual arrangement. On the SAS side, it's an occupational pension scheme and it's an individual registered pension scheme with multiple members. Just keep your eye on this one. So this infographic will pop up later in one of our case studies. So just keep your eye out for that one. So then why SAS? So I think we've got to really sort of have a look at sort of why people would look at SAS over SIP. And I think, again, Barry's mentioned in the session, you might think, gosh, well, we can do that under SIP. Really, your distinctions and the differentiators are the fact that it's an occupational scheme. It's set up by the sponsoring employer. And I always like to think of it as that scheme, that SAS belongs itself to the company. Whereas the SIP, of course, would be run by your Curtis Banks or your Talbot and Muir, and that SIP is actually effectively run and owned by that particular company. So I think that's important as one of the main distinctions why you might be looking at SIP, SAS over SIP. Then the next, I think, key differentiator is the loan back to the sponsoring employer. And I would really like to sort of go into that in a bit more detail. First off, on the SIP side, if a loan is made from a SIP to a connected party, that will actually create an authorised payment, an authorised payment and a tax charge for the scheme. So it's not available under SIP as an option. So under SAS it is available, so you can do the loan back of 50% of the net value of the scheme assets back to the sponsoring employer. I think that bit is key as well. That loan has to be used by the sponsoring company, and it has to be used for the purpose of that business, that company. I think it's good for you to know that you can't actually lend that money across to the sponsoring employer and then it, for example, move that money on to somebody else for the purpose of maybe another business. That's not allowed. It's just good to mention that bit. Also, loan backs have got strict conditions. There's 5 tests that we need to look at, which we're going to go on and have a look at in a bit more detail now. But failure to meet those conditions can be pretty serious. Again, if one of the conditions aren't met, you will end up with an unauthorised payment on your scheme, which we don't want, or your clients will rather. We want to sort of be preventing that. So I mentioned the 5 tests to make sure and enable that the loan is an authorised employer loan. So the 5 tests are, the first one is security, the second one is interest rates, the next one is the term of the loan, and then there's the repayment terms and the maximum amount of the loan. In practice, what do we see when we're going through those tests, and how do I actually like to tackle them? I usually go through them in the order that are on this slide. I think in terms really of security, there are challenges around that piece. So when you grant a loan back from a SSAS, you have to be able to secure the loan against an asset. So that asset then has to be equal to the capital value of the loan plus the interest. And what can that asset be? So in terms of Talbot and Muir, we'll look at commercial property, and actually being able to put a first charge on some type of property can prove challenging to clients. So that really is the first test that we always tend to talk about, and usually that's where the loan back will fall down. Let's talk about and have a quick look at the asset piece. So the first charge could be placed on commercial property. It's there can't be any other first charge on that property already. We will also look at residential property, but that can't be residence, a main residence that the client lives in. It has to be a second property, so which could be a buy-to-let property, it could be a holiday let, or it could just be a second property that the clients happen to have. The next bit then is who can provide the security. We will actually, it could be the company, it could be the clients, and it could actually also be a third party who's happy to consent that a charge is placed on their property. We do expect, though, that every time that we put a charge on, we would expect the person who is submitting that piece of security to understand the implications if that loan is ever recalled, or that piece is ever recalled because the loan has failed. It is absolutely important that the client or whoever it is understands those implications. What are the implications? So if there was commercial property, automatically we would expect to see that commercial property come into the SSAS pension scheme. With residential property, it's slightly different. The charge that we will take will be actually over the disposal of the proceeds rather than the property itself. We do that because we can't have residential property come into the SSAS scheme, because that would, again, it would give rise to a tax charge, which you don't want. You've already defaulted on the loan. We don't then want to be causing more issues by creating a tax charge for the clients. I'd like to say as well, Talbot and Muir will just look at property. We'll also look at land. That's the other type of asset that we'll be able to take a charge over. Other companies out there, they might look at other types of assets. So they could look at things like intellectual property, they could look at shares in a company, or if, for example, the company's a manufacturing type business, they could have some quite big piece of machinery that that they would look to be able to put a charge across. We don't look at those types of assets because we're not comfortable potentially with the valuation, and it actually all of those assets potentially could decrease in value, so we're not comfortable with that. We'll only look at commercial property. So hopefully that gives you an idea of the security piece on things. Next point that we look at is interest rates. So people will think, oh gosh, it's a loan, what interest do I have to pay? As you'd expect, the loan is there to generate some type of investment, which is the interest. A percentage needs to come back with that capital amount, because that's the risk that the SSAS is taking with regards to the loan would be offset by the interest piece. The minimum amount that is has to be charged on any loan within a SSAS is actually 1% above the average base lending rate of these particular banks. So at the moment, it's It's 5.25%. So it's 5.25% plus 1. So the minimum rate for a loan is 6.25% at the moment. think the MPC are meeting next week, so whether the base rate will change again, we're not sure, but if it does change, then that minimum amount will change at that point in time. Now, that's the minimum amount. You can actually charge more in interest on the loan itself. It's not strictly 6.25% the minimum. You can actually, the clients can actually decide, oh, actually, I think I will charge a bit more for that loan that I'm going to lend out to my company. It is possible. Of course, if we see things that are quite wild and wouldn't reflect what's happening out there with regards to an interest rate in the marketplace. So say somebody tries to put 20% interest on there, we would probably question that undoubtedly. So what we're actually looking for is something that's sensible in terms of that amount. Why do people want to look to maybe charge more? It's a good way of making sure that it's the investment piece is right for the client. Just thinking about it today, 6.25% coming in on half of your pension scheme, your SSAS amount, is probably going to generate you some quite good growth. Previously, so a couple of years ago, when interest rates were really low, that minimum rate was somewhere down at 1.25% at one point. So that was actually quite a low return on a 50% value of your scheme. So if you think an average scheme is probably around 400,000, 500,000, you're lending out £200,000, you probably want to generate a little bit more income from that piece. So it's possible, as long as the minimum is set, you can actually charge more than the minimum. So that's the bit on interest. The next test is the term of the loan. So the loan repayment will be 5 years. That's the maximum term that the loan can be set for. I think perhaps as you're looking through this slide, you've suddenly come across the word rolled over. I would just caveat that the rollover isn't there to be an automatic rollover. It's only there if there are issues and serious issues with repaying the loan. Actually, in practice, there should be a capital and interest repayment coming in as per the loan reschedule. So you shouldn't really be in a position where you need to roll over the loan, but HMRC does recognise that there could be exceptional circumstances where a loan does need to be rolled over. So it is possible, but it is only possible in exceptional circumstances. Anybody who was around before A-Day, pre-A-Day, would possibly be familiar with the term rollover, because pre-A-Day the rules were very different for loan backs. They weren't secured, for example, and you could actually go through the whole term and you didn't have to repay any payment until the very end. And then what you could actually do was then actually roll over the loan for another period of time. So don't get confused with that term rollover as a pre-A-Day term. We are looking for a maximum of 5 years and for the loan to be fully repaid. Okay, so I mentioned repayment terms. So the loan has to be repaid in capital and interest instalments. We have to really see there has to be a payment at most once a year coming back into the scheme. There can be repayments on a quarterly basis or a monthly basis. What happens is the client will let us know how they want to repay the loan, what they've agreed with the sponsoring employer. And what we'll do is we'll set out a repayment schedule, and that repayment will show the capital and interest and the date that payment has to be received into the SSAS bank account. We've got a little bit of a snazzy calculation up on the screen. If you have ever read the HMRC pension manual, this calculation appears in there. I'm sure you all have. But just to sort of go through what this means. It's not really that scary. It just looks a bit scary because it's sort of got, you know, got a different shortening of terms. So L is the amount of the loan, TIP is the total interest payable, TLY is the total number of loan years, and NLY is the number of loan years in the period. Let me just put it into a little bit of a case study to sort of show you what that sort of translates into. So a SAS is made by makes a loan to their sponsoring employer, Widget Limited. The date of the commencement of the loan is the 1st of June 2023. The initial amount of the loan is £50,000. The term of the loan, 5 years. The total interest chargeable then over that period works out to be £20,000. The amount repayable by the company by the end of the first loan year and then the subsequent year will translate into the 50,000 plus the 20,000 divided by 5 times 1, which takes us to 14,000. I mean, I always, with mathematical calculations, I do sometimes get confused with the square brackets and the curve brackets, but that calculation sits on top and then you divide it by 5 and times by 1. So that takes us to 14,000. So hopefully that gives you, puts that into a bit of context, gives you a little bit of understanding, I hope, with regards to the repayment terms. What we actually do in practice, if you're in discussions, you know, the client wants to sort of understand what it looks like, we can run some figures for you. We can give you some sort of calculations just to sort of show what the repayments can look like on certain amounts, and what they look like quarterly or annually. Do understand that the sponsor employer will also need from their side to manage their cash flows so that they can make those repayments back into the scheme. So, you know, we're quite happy to help out with that. So, you know, everybody's clear on what needs to be repaid and what it looks like, so it's not a shock once the loan is set up. The maximum amount of the loan, I think this is probably the easiest one out of all the tests, 50% of the net market value of the scheme. So what we'll do is on at the point before the loan is released back to the sponsoring employer, so the money goes out of the SAS bank account, we will ensure that we've done a calculation and we've calculated the assets of the scheme at that particular date. We top them all up, times it by 50%, and then we know we haven't gone above the 50% with regards to releasing those funds back to the sponsoring employer. It's that really is as simple as it sounds. If there's property in the pension scheme, yeah, we will potentially, if we've got a really old value for that property, we might look to get a side letter and confirmation from a valuer that of the property value, so we can include a realistic value in that calculation. But you know, it shouldn't be too complicated or onerous to get that value. As well, just as well to say, I think, in case anybody is sort of concerned or worried, the value of the scheme is measured at that point just before we release the loan. It's then not retested during the 5-year term of the loan. The only time that we would do a retest is if the members are looking to potentially do another loan, a new loan out to the sponsoring employer. Of course, just to sort of be sensible, there has to be then, you know, they might have made some more contributions into the scheme to bump that up to then be able to make a further loan back. So yeah, just to sort of say that is the only time we look to do a retest, is if a new loan is then looked to be granted back to the sponsoring employer. So yeah, Barry, I think we'll kick off with the case studies.
Lovely, thank you very much, Gemma. Thank you for that. Yeah, so let's just run through, as I said before, it's nice, simple, short, conceptual case studies, nothing overly complex. My first is really just reflecting or relating to the nature of a pooled fund. So we did a SSAS comparison. With a SIP, you have your own unique policy with your own unique investment strategy. under the SSAS, you pool your funds, pool your resources with the other members of the SSAS. So just sort of conceptual here. We've got a family business run by this family, might be multiple generations, perhaps 2 or even 3 generations of the family working in a family business. They've all accrued pension funds, but because of the period that they've been working, the period they've been saving, different amounts saved by each individual. It might be, my example here, might be that they want to access a discretionary management portfolio, perhaps a bespoke portfolio, and the investment manager might have a minimum investment threshold. Now, some of the members of the family might have sufficient resources to access that discretionary portfolio. They might meet the minimum threshold, but others might not. So if they were to establish a SSAS, pool or consolidate their funds together, we now have a single investments fund and a single mandate for the DFM. It might not just be that you've got an investment threshold. I know a lot of DFMs now do have thresholds, but they're quite low. That may not be the issue. It might also be charging. So if we look at Pugsley here, he's got 20 grand. Now, he's probably below most DFM's fully discretionary portfolio threshold. But even if they were prepared to manage his money at 20,000, if they run a tiered charging structure, ironically, with the smallest pot, he's probably going to pay the highest fee. By consolidating all the pots together, Pugsley's £20,000 is part of a much bigger pot, which is over £750,000. So access to a portfolio he may, or portfolio services he may not otherwise be able to get access to, and a tiered charging structure that's more advantageous than he'd be able to get access to using simply his own resources. So just a reference to the nature of that pooled fund. Next, very, very simple. Just like a SIP, if the members of a SSAS want to buy a commercial property, they could purchase a commercial property. That commercial property is an asset, an investment of a registered pension scheme. As such, any future growth on disposal, no liability to tax. Any rental income, no liability to tax either. So the directors may have pooled their funds within a SSAS to acquire this commercial property, generating tax-free rental income. Great investment, shielded the asset from tax on capital growth in the future, shielded the rental income from tax as well. Couldn't be simpler. In addition, it might be, just to illustrate the fact, just like a SIP, a SSAS can borrow money. The members of the SSAS might want to purchase a property, but the fund isn't sufficient. They may be able to approach a bank or other lending institution that may be able to lend the SSAS sufficient monies to bulk the pot up. In my example, more than sufficient funds. They purchase the property, still got some cash there for a bit of liquidity, a bit of diversity, the ability to pay fees going forward. The rental income's coming in tax-free, and then the rental income can be used to service the mortgage or other loan. So we have a geared asset, but the geared asset is self-sustaining. The income being generated from that asset is actually servicing the loan that was acquired to purchase the property in the first place. It might be, and any number of your clients who run businesses, it may well be that the company, the business itself, owns a commercial property. And the company might want to release cash. It may want cash for various purposes, business expansion, development, etc. Could be short-term, could be long-term cash requirements. So in order to release capital, rather than necessarily going to a bank or other lender and having to borrow money and paying interest to a third party, if the directors have a SSAS in place, the SSAS could purchase the property from the company. It's a connected transaction, but it's not an issue. That's absolutely fine. The SSAS now owns the property, and the cash is now injected into the business for the business to use for whatever it needs to invest in to develop and expand the business. There is a price to pay because previously the company owned that property, and of course it was not required to pay itself rent to occupy a property that it owned. The property is now owned by the SSAS, So the company will be required to pay rent to the SSAS. Now, on the downside, you think, well, that's a cash flow issue we didn't have before. But is that a price worth paying? You've now released the capital into the business. Yes, you're going to have to pay rent, but at the end of the day, is that a price worth paying? And also from the perspective of the members of the SSAS, this might well be a price worth paying because, of course, the company is now paying rent into their pension fund. So it's paying rental income, tax-free receipt into the SSAS. From a tax planning perspective, imagine this company, after all expenses, was going to have taxable profits of, let's say, 50,000. So corporation tax rates have gone up this year, as you know, but for companies with profits up to 50,000, corporation tax at 19%. So if the company was going to have taxable profits of 50,000, corporation tax at 19%, corporation tax bill about 9.5 grand. But they've sold the property to the SSAS. They're now having to pay rent, in my example, let's say £10,000 of rent. That should be an allowable expense, a deduction from the company's profits. So it reduces the company's profits, in my example, to 40,000 with a corresponding reduction in the corporation tax liability. So there's a tax planning benefit there as well. And another point, imagine the director of this company, they want to extract profit from the business in the most tax efficient way possible. So on your advice, they are paying employer pension contributions of £60,000 a year. So that's pre-tax revenue of £60,000 being extracted from the business, paid into their pension every year. Well, now they're also paying £10,000 of rent, which should be an allowable deduction. So we're now getting £70,000 of pre-tax revenue out of the company and into the pension. So £70,000 of revenue without liability to corporation tax, national insurance or income tax. 70,000 into the pension, despite the fact that the annual allowance is only 60,000. Is the rent an employer contribution? It absolutely isn't. The question does get asked fairly frequently. The rent is simply an income from an investment that's held by the pension scheme. So there are a good number of reasons why the client might want to do this, particularly if they want to release the cash into the business, but perhaps even if that isn't the primary driver. Company establishes a SSAS. Company makes contributions into the SSAS for the directors for a number of years. Just good, solid financial planning, retirement planning for the directors. But most people view their pension fund as money that's essentially locked away for the future. I'm putting this money in a box and I won't be touching that until at least my mid-late 50s, perhaps my 60s. However, at some point in the future, the company needs a capital injection, a bit of cash. In my example, it might be to install a new phone system or an IT system. It could be to acquire new plant, machinery, lorries, etc., whatever the requirement is for cash. The default solution might be to approach a bank or some other lending institution. But there's all sorts of reasons why that might not work. It might be simply that the business does not want to owe money to the bank. And it may be that the bank is simply not lending. Bank lending policies change fairly frequently. They may not be lending, or the lending rate could be prohibitively high. So at this point, we now tell the directors, this pension pot, this money that you set aside for your own retirement, actually, we might be able to release some of that money back into your business. So subject to the SSAS trustees accepting that a loan back to the company is a viable, suitable investment, the SSAS might be able to lend money back into the business. The directors can then use that money to invest, in my example, the IT system, the phone system, or whatever other investment it needs to make. And that might be, quite a nice and surprising thing for a lot of business owners to think, well, you know what, I kind of put this money in this box over here, not expecting to see it again until I retired. But actually, the fact that I can draw this money back into the business is fantastic. Yes, it's a loan, it has to be repaid, but you're repaying that loan back into your own pension. Yes, you've got to pay interest, but you're paying interest to your own pension. And I'm no corporate tax expert, but my understanding is the interest should be a deductible expense for the business as well. Oh, there we go. For example, we've got a business, Goodwood Limited. There are sawmills. They normally just buy in timber wholesale, sell it retail, or process timber and then sell the end product. They've decided to sort of take control a bit more of the value chain. They're going to start building product to sell. So they're going to start building wooden garden furniture. They've got the skills, the knowledge, the experience to do it. What they don't have is the machinery. They could hire or lease the machinery. They would rather not do that. They'd rather own the machinery as part of the business, as an asset of the business. They've got retained profits in the business, more than enough to buy the machinery. We'll assume, in my example, it's going to cost £100,000 to buy the machinery. Let's assume instead, rather than simply buying the machinery for £100,000, we'll assume there's enough retained cash in the business and that the directors have sufficient unused annual allowance and carry forward that the company can make a contribution into a SSAS of, let's say, for the purposes of my case study here, total contribution of £200,000. Of course, this might not be necessary. There might already be monies in the SSAS, but let's assume we're starting from scratch. £200,000 contribution into the SSAS, subject to the wholly and exclusively requirements, an allowable expense of the business, assuming corporation tax of 25%, the contribution saves £50,000 corporation tax. We will assume that they've considered this loan in advance of the exercise and they've already established that, yes, we're going to be comfortable making this loan. The SSAS is now in a position to lend the company £100,000, which the company can then use to purchase the plant and the machinery. So option one, they've got £200,000 available to spend, £100,000 on the plant and machinery, hopefully some corporation tax on that. £100,000 could have gone into a pension, corporation tax on that. The plant and machinery will hopefully qualify for corporation tax relief if it falls under either the annual investment allowance or, as was introduced in the budget, the full expensing allowance, 100% upfront tax relief. So as I say, option one, £100,000 expense on plant and machinery, at 25% corporation tax relief, £25,000 tax saved, £100,000 contribution into the pension, £25,000 tax saved, total expense £200,000, total corporation tax saving £50,000. But by going down the £200,000 contribution into the SSAS, meeting the wholly and exclusively requirements, 25% tax relief, £50,000, the money's then lent back to the business, £100,000 invested. That qualifies under the annual investment or the full expensing allowance. So the same £200,000 expense has now attracted £75,000 corporation tax. Yes, the business owes the SSAS money, but that money's being repaid into the director's pension. Yes, it's liable for interest, but the interest should be an allowable deduction from from profits, and that's an investment return back into the SSAS. I'll hand back over to Gemma.
Thank you. Thanks, Barry. I think pretty powerful stuff there. So I think our next case study is about multiple SIPs or a SSAS. So in our scenario, we've got Ron and Eileen Over, who run a small family business. And fantastically, they have the opportunity to buy their trading premises from their current landlord. So they think that might be a really good opportunity for them. Unfortunately, though, they have insufficient funds within the business to purchase the property, but they do have some pension funds, which they could potentially consolidate together and then look to purchase the property. a couple of other factors within their business. They run it with their son and daughter-in-law, Ed and Carrie, as well as their granddaughter, Izzy. So what we've got there is we've got a 3-generation small family run business. So immediately I'm thinking, oh, SSAS would be a really good route for them to take and to consider. Or potentially they could be looking at 5 SIPs together. So I think there's some sort of different ways of thinking with regards to whether they go down the SIP route or the SSAS route. And of course, it is absolutely essential that you look at both routes potentially, so they don't miss out on the opportunity to have a SSAS which could fit their requirements quite nicely. So obviously you're looking and you started to think, right, SIPs, we've got 5 SIPs. We know we can purchase commercial property under the SIP. Yes, that could be a good option for them. On the SSAS side, there's a limited company. They've got a sponsor and employer. They are 5 family members. They have pension pots that they can pool within the SSAS and then look to purchase the property. Potentially there's a little bit of flexibility there with regards to adding the new members in. Do they all have to join the scheme at the same time? No. They could potentially look at maybe Izzy accruing more benefits as she goes along and has more annual allowance to use up. But of course, there's going to be some pros and cons with both of those strategies. So we'll go on and have a look at that in a second. And also, I think we've also got to bring in an element of how much does each scenario cost as well. So what does it look to have 5 sets of SIP fees, property and transactional fees, and then what does it look like to have a set of SSAS fees? So here's the infographic that I did mention we bring up again. So got that in. So let's have a look though now at the pros and cons on what SIP would look like and what SSAS would look like. So obviously, if they set a SIP up, they would each have their own individual personal pension. So indeed, they can all link together and purchase the property still. So for example, just to keep it neat, they could purchase 20% of the value of that particular property and bring that into their pension. It's likely though that what they'll have different values coming in for each of themselves, because I think Eileen and Ron probably is probably correct to say they might have accrued the most benefits within the 5 individuals, and like I said, Izzy might not have accrued that much in terms of a pension pot. Also, the other part is you've got your 20% which would be invested in property of the value of the property. But the rest of the SIP value, the benefits that come across into the SIP, can be obviously invested in, your DFM, some type of standard investment, and it would be private. So whichever strategy the individual decided to take, the other 4 members don't need to sort of know what options, what else is in their individual SIP, unless they choose to share that. I think that the downside is multiple fees. So you end up with 5 plans, and just as an example, I think where you can start to look at SSAS is where you have 2 SIPs versus 1 SSAS. As the number of SSASs grow, it actually, that SSAS fee looks quite very competitive compared to 5 individual SIP property fees. And the other, I think, con is the fact that, with the younger members, they might not have as much money. So their fee will be being absorbed. They'll have further absorption with regards to their own particular fee, because it'll be at a higher value. And they've got a lower pot compared to those individuals who've had lots of years in saving in pensions. I think that needs to be borne in mind as well. Then with regards to SSAS, Sorry. So there we go. So we've got a pooled fund. The members collectively have control of the assets within the SSAS, so they make those decisions collectively. There's also, as well, if they're a small limited company, they might have the potential to use a loan back in the future. So that feature might be appealing to them as a business. And of course, the pro is there is a single set of fees, which we will go on to discuss, as I've just given you a quick hint as my clicker went off. But then the con side of that, looking at SSAS, is, if you remember from our last session, is we were talking about those member trustee duties and that increased administration burden. Although if you have someone like Talbot and Muir involved, we're actually picking up a lot of that function. But I mean, the individuals who join the SSAS, they do need to be aware that they are member trustees and that there are duties that they do have to take an interest in their scheme as they go along, and are involved with the SSAS for however long that they keep the SSAS going for. The other thing that I think I need to mention is the fact that on the SSAS side, if, for example, 3 of them decide to join the SSAS and 2 of them don't want to, they don't have to at that time. But if in the future they decide to invite, again, those individuals to become members, there's that option that they can join the SSAS at a later date. And actually, there's no changes with regards to that property structure. You don't have to do anything to say, right, that's now owned because it's a pooled investment. It's a pooled investment strategy, which I think is quite neat. So in terms of fees and charges, let's have a quick look at those. The types of charges that you're looking for under a SSAS that will be included. There'll be an establishment fee, there'll be an annual fee, commercial property acquisition fee, potentially other property related fees, which could be on a time cost basis. So things like if there's a rent review that needs to be done or a lease review, that would be charged on a time cost basis. As the SSAS grows, there could be other investments that need to be included, so there'll be fees for that. And then eventually there'll be fees potentially for making retirement benefit payments. And of course, if new members want to join the scheme, there'll be a new member type fee. But I think the good thing is, with regards to the SSAS, the sponsor and employer could pick up that fee, as well as the fee can come directly from the scheme. So it doesn't actually have to come out of the individual's pockets, which is good. There is, of course, as well, if the sponsor and employer pays the fee, there's the option for that to be offset against corporation tax. I think, though, I know I've said about fees, but I don't think it is just about fees. You do have to take into account, and I think you do have to weigh up what the fees look like if you're going down the SIP route or indeed the SSAS route. But I think the fundamentals are actually what is right for that set of that group, that family set, what will sit with them in terms of their long-term financial planning. Where do they want to go? How do they want to use the scheme, and what's the best option for them? I'm a little bit biased, and I have to say, for this particular group, I think the SSAS would be the best structure, because the beauty of it is the older members might want to retire and they can do that. Younger members will want to be included. Other members might want to come along. So, for example, Izzy might have a partner in the future who might want to join in. They can feasibly come and belong to the SSAS scheme. And you don't have to change the structure of the investments necessarily. That property can stay in there. So it's a really good way of sort of utilising your pension sat next to sort of your business planning. So I just think it's a really good feature. It's a good thing to have. Just to sit aside from that, if those individuals want to have another pension scheme outside of the SAS, it's perfectly feasible for them to be able to set up a PPP or a SIP, and they can hold other assets, make contributions into another pension scheme in their individual right, which is absolutely nothing to do with the SAS. So it's possible for that scheme to receive future contributions, to hold other investments, and to take benefits. Why would they do that? Potentially, we've got SAS as a pooled investment. Those investments have to be decided and agreed on by all the member trustees. And yes, individuals within a group can have very different risk profiles. They can have different attitudes to risk and capacity for loss. So that can be sort of structured outside of the SAS and be tailored by a separate personal pension plan that would sit alongside the SAS. So I think, I think I'm back over to Barry now for Canny Planners.
Thanks very much. Thanks very much, Gemma. So just another case. I'm following on from that. I think that last case study is probably the case study when it comes to SIP or SAS, actually, because it deals with a lot of the issues. Are we identifying that this client could be eligible for a SAS, and where might the balance lie between the two options? Just another case study though. We've got Cozy Planners Limited. It's a wealth management company, quite a small company, but very successful, very profitable. But the directors of the business wanted to expand, so they decided this year they're going to focus a lot of time and effort, and they've set aside quite a lot of financial resource to bring in some new staff, some new advisors, some new back office staff. They want to scale the business up. As a result of the recruitment efforts and sort of being slightly distracted from their day job, the directors, they've made a profit for the year, less than previously, let's say 100 grand. They have substantial retained cash profits in the business. They didn't have to spend as much as they thought on the recruitment drive. They've geared the business up to be really successful in the future, and they think they deserve to pat themselves on the back. So they decide to make a company pension contribution into the SAS, annual allowance plus available carry forward if relevant or necessary, just to reward themselves 300 grand. So if we assume that meets the wholly and exclusively requirements, then we've made a £300,000 contribution, which is deductible. First question, they only made £100,000 of profits this year. £300,000 contribution would put them at loss if it was an allowable expense. So first question, I suppose, is it even possible to make a pension contribution that brings you from trading profit to loss? Is it even possible for that to meet the wholly and exclusively requirements? And the short answer to that is yes. The pension contribution is staff remuneration like any other. So whether or not the company is in profit or loss is a separate issue from whether or not the contribution meets the wholly and exclusively requirements. I suppose for context, I think there's any number of companies out there that may on occasion trade at a loss, but they've still got to pay their staff. So that's the first point, that there's no, in itself, the fact that the contribution might put the company into a loss is not in itself a reason why the contribution won't meet the wholly and exclusively requirements. But the next question, which is probably the better question, is should they make the 300,000 contribution this year? They've only got £100,000 of profits. So if they made a £100,000 contribution, that would wipe out the profits. That would maximise their corporation tax relief. So should they just hold on to the extra 200,000 and make that contribution next year or the year after? Kind of depends. Built this case study last year before the new corporation tax rates were announced. With the corporation tax rates going up, there's an argument for it, for waiting. But if we assume that they're planning on maxing out their contributions in the years going forward, what's the impact of making this contribution now? So first of all, first 100,000 wipes out the profits for the year. The next £200,000 the contribution creates a trading loss. Can we do anything with that loss? We have a chat with a company tax advisor and he says, well, actually, we may better carry this loss back to the previous trading year. So current year profits would have been 100,000. The first 100,000 of the contribution wipes that profit out. Corporation tax saving, sort of a combination of 19% and the marginal rate 26.5%. So we saved that corporation tax for the year. Assuming we can carry the £200,000 loss back, what profits were posted for the previous counting period? In my example, 220. We can set the loss to adjust last year's profits. We can now save £200,000 or reduce the company's profits retrospectively for last year by 200,000. Last year, the rates were 19%. But the point is, yes, the contribution exceeds profits. Yes, it's created a loss, but we may still be able to carry that loss back and still get full corporation tax relief available. And obviously, with, as I say, the rates of corporation tax going up, it might be that it might be more economically sensible to hold on to that money and make the contribution next year, but not if they're planning on maxing out their allowances anyway. You know, they might as well take advantage of the contribution now. So that brings us pretty much to a close, although we do have one more poll question for you before we finish. So your bit of participation would be great, and then we've just got some questions. We'll hopefully quickly have a chance to deal with those. So, quick question for you: where you have advised on or assisted in the establishment of a SSAS, what was the main reason for using a SSAS? To pool funds for property purchase, general family, business and intergenerational planning, loan back or the potential for a loan back in the future, or other? So if I just ask those of you who are happy to participate, if you can put your answers in there, that would be great. Oh, yeah, okay, there you go. That's very probably as we expected. I think that the main driver, in fact, is to pool funds for property purchase and general financial planning, intergenerational planning for family businesses. And loan back sitting quite low, which is interesting, but that's really helpful. Thank you very much for your participation in that. We are kind of out of time, but we will try and deal with some of these questions if we can quickly. So first one, Gemma.
Yeah.
Loan back.
Yeah.
Does the charge on an asset, i.e. property, have to be first charge? And can it be on assets of more than one property, more than one asset?
So yes, it does have to be the first charge, and it can be across more than one property, but do we ever really see that? Not really. Generally, there are costs because the solicitor has to put the legal charge on that particular asset. So if you got two assets times two charges, so two costs, not charges. Not to confuse things. So yeah, it's possible, and it does have to be a first charge.
Great, thank you very much. Just looking at it, Ravi, we're going to run out of time. Ravi will get in touch with you separately about your question. It looks a little bit more involved, even though I haven't had a chance to read it properly yet, but we will get back to you and deal with that query for you. Right, so does the variety of ages and stages of life of members have any impact on group SIPS syndicate purchase versus SSAS in terms of getting the risk strategy right? This is an interesting point, I think. When it comes to a pooled investment, yes, every client will have an attitude to risk or capacity for loss that will be potentially unique to them. But I suspect that if their overarching objective is to, for example, buy a commercial property, the client has a compromise. You know, my general attitude to risk is here, but pooling my funds with others to purchase commercial property is here. Well, there's a compromise. What is your overarching driving objective? As Gemma mentioned, though, if the client has sufficient resources, they might say, well, actually, this portion of my overall pension wealth is going into the SSAS to form part of the pooled funds that will be used to purchase the property. However, to balance my risk, I might keep this portion of my wealth separately in a personal pension or a SIP and manage that according to my attitude to risk or in some way that mitigates the risk that I see in the pooled fund. So there is a risk, but there are two ways, in my view, of dealing with it. One is to separate out your pension wealth, and the other is to have a pooled strategy agreed by the members. I think it's unavoidable when you have a pooled fund. I mean, it's unavoidable, isn't it? a pooled fund with multiple members, potentially at multiple ages and life stages, there will be a degree of compromise in terms of risk. Gemma, I don't know whether you're, from your experience, you'd...
Yeah, I agree with that entirely. I would just say as well that when we have these type of arrangements, even if they are family members, and so you'd expect that they should all get on quite well, hopefully, with each other. Just to sort of caveat the other part of the arrangement of having a SAS or group SIPs and all being involved with regards to a single property, which is illiquid, essentially. It's got its value, but to have any liquidity if anybody wants to leave, you do have to plan for that in terms of that particular strategy. But I would always suggest, whether it be a group SIP scenario or a SAS scenario, that the members actually collectively do get together and discuss their SAS, at least once a year, just to make sure that they're all on the same page with regards to the strategy, particularly when there's a property involved.
Yeah, going in with eyes open is the critical.
Definitely.
Yeah, absolutely. And hopefully, David, what in the third session, because this is the second of a 3-part series of SAS webinars. In the third session, I'm hoping that's something we're going to address in what we're going to call a sort of frequently asked questions session, or myth busting. Some of the, not just the opportunities, but also some of the challenges as well. And that structure, the nature of a pooled fund, multiple investors, different ages, different life stages, different risk attitudes. That's part of hopefully what we will deal with in the third webinar as well. I'm very conscious we've overrun on time. Thank you so much for the patience for those of you who've stayed on the call. And as I say, Ravi, we'll have a proper read of your question and get back to you separately, mate. Thank you very much, everybody.
Thank you.